Hey, everybody. Welcome to the next episode of the Fireside Trader Podcast. Five questions with Louie Navellier. JD here. Louie, we're recording this on the heels of an historic Supreme Court. Um, I don't know. Do you want to call it a beatdown?
Well, we've been listening to all the legal experts, and Trump has 4 to 5 different remedies. Apparently, Congress is supposed to authorize the tariffs, so he can get them to authorize. The tariffs will continue, according to legal experts. The Supreme Court doesn't provide remedies. Any remedies like disgorgement of previous tariffs would go to the appellate courts. So basically, the life goes on, and then they can challenge further.
What do you make of the market reaction? I guess I was a little surprised at the enthusiasm, especially when bond yields spiked on worries that this will negatively impact our deficit and ability to pay our debts.
The bond yields are hardly changed to me. I mean, let me look at them intraday. Yeah, they did spike, but then they've settled back down. So the 10-year hit 4% on Thursday, and then it rallied back, and it's just in the trading range now. So it's under 4.1, 4 point. It's under 4.1%. So no big overreaction. I
The
just
stock
think,
market's controlled by computers, Louis, and I'm always astounded at how one-dimensional the computers are because there are multiple factors that the market needs to consider today, including economic data that really wasn't supportive for higher stocks.
yeah, but earnings are still coming out. Like we have comfort systems today, and they beat, and that's why that's the symbol is FIX. This is a air conditioning company, okay? It provides air conditioning to the data centers,
Ah,
and they
that's why
beat.
we need to build those things in space.
Yeah, we had a conversation on that. There's a bit of a physics problem, okay? Um, but yeah, no, they had a 38.4% earnings surprise, which is huge, okay? And the revenues well, the revenues were up over 40%, but the revenue beat, I'm trying to find the revenue beat here. But yeah, they're up sharply. It's order backlog, it's guidance. So that's what you got to do. We before today we had Quanta Services, PWR, and they gapped up yesterday. So Wall Street loves the data centers. I can tell you that. That's a hot spot in the economy. Of course, we've had GDP revised lower due to the higher trade numbers and the government shutdown. So,
Louis, you with talking about comfort systems on the earnings calendar this week were a number of your gold mining stocks, and I'm curious how those companies fared when releasing results.
yeah, all gapped higher, but gold prices are going higher anyway. So, no problems there.
And that sector leads me to one of my questions for this week, Louis. You often talk about alpha and owning sectors that zig when the market is zagging. And I know the gold mining sector or gold stocks in particular are in the crosshairs of that methodology. Are there other sectors that do the same thing? And if so, what sectors should people be or investors be looking at today?
That's the whole problem. It's not a sector market. It's a stock picking market. So, the best semi is NVIDIA. The best AI appliers are App Loving, which did announce and improve, and Palantir. Now Palantir went up because they're moving to Miami. They went Palo Alto, Colorado, now Miami. And then all the people building out the data centers. And I have several of them. And then there's Lilly. I have one other healthcare related stock, Cardinal Health, CAH. And then I have the 20 gold stocks that are going nuts because gold keeps going higher.
You've got my wheels spinning. Just a kind of a fun exercise that maybe we can talk about, and it deserves a longer conversation. But I love portfolio theory and all of that kind of stuff. And constructing a portfolio today, I guess if I were to give you a clean slate and I said, build me a portfolio right now, you
That's it.
mentioned some of the names that you would
No,
include.
that's easy. We throw an optimization model and tells us precisely how to mix the stocks to get the highest alpha, the lowest beta, and the lowest standard deviation and residual variance.
Well, first question
Okay.
is how many stocks populate a portfolio today?
Well, it depends how conservative you want to be. The more conservative you are, actually, the less diversified you are. As you get more aggressive, then you'll start to buy some of the higher flyers, and there'll be smaller allocations. But normally, we recommend 60% conservative, uh, 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 30% mildly aggressive, and only 10% aggressive. And what's conservative today can often become more aggressive down the road. Um, as it appreciates, it tends to get a little more volatile. That institutional buying pressure, which makes the stock safe, lowers its standard deviation, then will get more volatile.
When you mix that all together, then how many stocks, just in general, are we talking 20 stocks? Are we talking 50 stocks?
Uh, Large cap, we only need 26 to 33, and all cap, we need 50 to 80.
Okay.
And then the people that get my Platinum Growth Club have an allocation tool where they key in how much they want to invest, and we have three different portfolio models for them and tells them precisely how many shares to buy to the
Is that
71.
similar then to the optimization model you
Yeah,
were speaking
yeah,
of?
yeah. But we're walking along the efficient frontier there. Um, Normally I optimize at the tangent where you can get the highest return, least amount of risk, but you can increase your return if you want to buy some of the riskier stocks, but it'll be more volatile.
While I was waiting for you, the sun was shining, and I'm going to get caught in a little bit of a rainstorm here. So if it gets a little heavier, I'm going to have to move to
Okay.
the inside here. But I'm good to go
Well,
so far.
just try not to get struck by lightning.
Yeah, I'm still down in Arizona, and yeah, it's just a gentle little sprinkle here so far.
Great.
Mostly evaporates before it hits the ground.
Mhm. Yep.
Okay, well that's interesting, Louie. I know folks listening heard you say dancing along the efficient frontier, and I'm sure most people have no idea what that means. So why don't you take a minute just to explain what exactly is the efficient frontier?
So all the marketing on Wall Street, target funds and stuff is just marketing. There's no analysis behind that. They used to tell you if you're 70 years old, you'd be 70% bonds, 30% stocks, and 80 years old, 80% bonds, 20%. That is just marketing. Okay. That is not optimization. And of course, the problem with that model is it collapsed because if you look at TLT, that's the iShares 20-year ETF. Um, it lost a lot of money in the last few years. Specifically, it has lost 37.71% in the last 5 years. So that's because Janet Yellen lost control of the yield curve. Okay. And not that
Hmm.
long ago, it was over 40%. So all those things blew up and they threw everybody into private credit, which does yield more, it yields 11%. But Blue Owl has had to close one of its redemptions on one of its funds. Okay, I think it's Blue Owl Corporate 2. And so now, yeah, earlier in the week, all the private credit stocks were crashing and burning.
Yeah, I know Blue Owl is kind of the poster child, and it's amazing watching the Wall Street machine work. I've mentioned a buddy of mine that works with Morgan Stanley, and they're just so rote in how they operate.
Oh,
Meaning,
well, no, he'll get fired if he doesn't do private credit. So McKinsey took over Morgan Stanley.
yeah,
They hired Mike Baker as the strategist. Mike Baker told everybody for 6 straight years, stocks are shit, run. Get out, run.
Yeah,
Stocks are
yeah,
horrible,
yeah,
but do private credit and do alternative investments. And I just looked at a $20 million uh a Morgan Stanley account to do because we do portfolio checkups, and
yeah,
less 10% was in stocks. But the reason your friend, the financial advisor, get fired, he can't make so you get a 2% placement fee to go to private credit and or some of the private equity funds, and I get a 1.5% of your trail. So he can't make that doing a stock portfolio. There's no way for him to get a 2% placement fee plus a 1.5% trail.
yeah,
So if he does stocks, it's because he wants to be poor and be terminated by his firm. Because in the business is called Y2B, yield to broker. And people don't realize that Wall Street runs on a spread model, not a management model. Wall Street's goal is to fleece investors on spreads. Okay, it's not to suck fees. They do both, but the fees make more, the spreads make more than the fees. So I have friends that have moved from the mutual fund business to the ETF business, and they just keep railing about how much money they're making on the spreads. Now, what's interesting is the crypto spreads aren't working. The Ethereum ETF with iShares has not been out for 2 years, but it dropped well over 60%, and Ethereum only dropped 24. And so the difference between 24 and 61 is the spread. But after market, they were the market makers were making 115% just on the spreads. Now I noticed that Harvard Endowment the other day was selling some of the Bitcoin to buy this Ethereum ETF with iShares. And I says, how dumb is the Harvard Endowment to pay those kind of spreads? Do you know what I mean? So, see, I can't fix stupid,
no, that is
but
confounding.
Wall
And you
Street
would think
runs on a stupid model, okay?
you,
And
you,
leverage debt is unbelievable. So down here in Palm Beach in 2008, under him Bernie Madoff, we had the leverage munis blow up. I got to explain the leverage munis. 6 to 1 that was leveraged, people earning 13 to 16% of your tax-free and A-rated munis. There's a 3% spread on the munis. So when you leverage them 6 to 1, the firm doing the designing them were making 18% on spreads. Okay. And then they had to buy a credit default swap, so maybe they only made 15%. But when the credit default swap failed, they had to unwind it all at once. And rather than working the order and maintain an orderly market, because all those munis to this day are fine to this day,
yes,
they rated. They were forced to sell all at once in a mini black swan event, and they lost 97% of everybody's money. And the genius behind the one I went to the presentation on, the Citibank one, was Jack Lew. And then he became our Treasury Secretary after losing 90% of everybody's money and fleecing everybody in these leveraged muni products. So again, Wall Street runs on a spread model, not a management model. Everybody's got to realize that. So, ESG was an excuse to run money. You got to have more international exposure. That's an excuse to run money. So when you are a strategist at Wall Street, all you want to do is get the money moving so the firms can get more spreads.
you're telling a story that resonates to me in terms of what's happening in the Bitcoin market. That this machine has been built for I guess large institutions to uh, do financial engineering and place they've created this market out of literally nothing because Bitcoin has no utility. Now, other areas in crypto, like on the blockchain with stable coins,
Mm-hmm.
that's a different story. But I'm just astounded at this Bitcoin Ponzi scheme that they've created enough liquidity in the market where now you've got options on ETFs and all of this kind of stuff that you can do arbitrage trading again just to churn accounts to make money off of the activity that's happening in crypto. It has nothing to do with the underlying, you know, I should say non-utility of the underlying asset.
Well, first of all, obviously, Ron's in the news, but when they would give money to Hezbollah or Hamas, the hoodies. They would often do it in crypto, so it can be traced. Okay. Um, and that's how crypto evolved, and blockchain evolved. So they could basically fleece people. But you can go to morningstar.com and you can key in your ETF and you can see what the spread is. Okay.
Yeah.
And that's what everybody has to do. And I know that's an extra step, but if you don't pay a big spread, you'll feel better. So just for your amusement, I just put in the Grayscale Ethereum ETF, that's ETH,
Okay.
and I can confirm that at this moment, there's only a penny spread. So go ahead and buy it. Okay. Uh, Now it did lose a lot of money in like the last year, it's down 29.54. But at this moment, it's sufficiently priced. So you have to wait to trade everything on Wall Street. You have to check the ETF spreads. You don't want to sell the bonds in a black swan event. You don't want to sell the stocks in a flash crash. You wait for the bounce. Wall Street will provide you liquidity if you don't mind being fleeced.
Well,
Okay.
and I think these Bitcoin and it's just fascinating watching again, it behooves those institutions to keep the machine running, and they're defending Bitcoin down 50% from its peak. But again, until they can provide evidence of a utility, I fail to see where the catalyst is. So if you're involved in Bitcoin, I'd be very skeptical of what's going on right now.
Yeah. Yeah. So now I'm doing the iShares dividend ETF. This is DVY. This has a 2 cent spread. Okay. So it's officially priced as we record this. So that's good. Now
Okay.
we're getting close to the close and the spreads often get tighter.
Yep.
But this particular ETF DVY dropped 34.95% during the flash crash. And by the end of the day, it was unchanged. So you could have lost 34.95% of the opening if you had a stop loss in. And that's why stop losses have been banned for registered investment buyers since 1968, because it would just be the tail wagging the dog.
Yes.
Anybody who sells you a stop system is using software, not rendering investment advice.
Yeah. Interesting. Louis, last question for the week for me. Been looking at the casual dining space, and I know you had been, uh, I guess, I don't know if you owned it or were just recommending it. Brinker International, ticker symbol
Yeah, I own
EAT.
it, and it got hit. And let me just update you on Brinker. So Brinker had a big surprise, a 24-cent surprise. That was a big, big surprise. It surprised the last 4 quarters. Their sales are forecast to be up 3.5%. Their earnings have been unchanged by the analysts for the last 90 days. Next quarter, it's 8.4%, so it's starting to slow down a bit. It will probably surprise again. Obviously, this company makes money selling you carbs and drinks. Okay. And I believe this is Maggiano's Italian restaurant
Olive Garden.
And Chili's
Or
and Chili's.
no,
Olive Garden.
Darden
Olive
is
Garden is
Olive
Garden.
Garden.
Yeah, yeah.
Yep. Yep.
So you're a pretty healthy fellow, so you probably don't eat at Chili's too much. But
I don't.
you want to order that onion thing, okay?
I'm gonna go have sushi tonight, Louis.
No, you want to order the deep fried onion thing, with the butter,
The blooming
buttermilk
onion from
batter on it.
Outback.
Yeah, 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 yeah. Well, Chili's has that too. Okay,
Yeah.
so I
Okay,
admit
well, Louis, I'm getting rained on here, so I'm going to cut this short. I
that.
appreciate
Okay.
you joining me this week for 5 questions with Louis Navellier. Always a great conversation, Louis. This is JD for the Fireside Trader. Thanks for joining us, everybody. Take care. Good luck with all of your trading, and Louis and I will see you all next week. Take care, everybody. Thank you, Louis.
Okay.